they are trying to bring about demand destruction, basically in their view, a mild recession, but it could become a more severe recession.
Do you think this recession is inflationary or going to be deflationary?
It's hard to cause a little bit of a recession. Historically, every time employment goes up by 50 basis points, it keeps going from there. And it goes much higher than that because you have kind of a feedback loop, and it becomes a vicious cycle that keeps getting worse.
You've been one of the most interesting people I've talked to, certainly. All right, guys, welcome. This is a very special video. We have a very special guest in this particular video. We have Lyn Alden. She's a brilliant economist and also an analyst, which I follow her articles on a regular basis. She has a wealth of knowledge, especially when it comes to markets, crypto. What I want to talk about, first of all, with you is the probability of a major recession. I have to be honest, there's a lot of data that suggests that a recession is likely this year, by the end of this year, or even next year. There's also data that contradicts that, says no, maybe not. So there's a lot of confusion going on here, and I just want to know what you think about that. In one of your interviews I watched, you mentioned something quite interesting, and I wanted to read this. You said that, I think from what you understood from what you said was that central banks, or maybe the Federal Reserve, is deliberately perhaps trying to bring about a recession, or a soft recession of some sort. I think you mentioned something about a soft landing. In other words, bring about a mild recession to reduce demand and thus reduce inflation. And that's why central banks are tightening monetary policy to make it harder to borrow and reduce housing activity and all that kind of stuff. Am I quoting you right? And what is your view overall about a recession potentially?
Yeah, that is something I've written about, that basically that they are trying to bring about demand destruction, basically in their view, a mild recession, but it could become a more severe recession. And that's because central banks obviously have very limited tools. They were only part of the reason why we had inflation. A lot of it was the fiscal spending combined with, real world constraints on energy and things like that. And so, they have limited tools on then how to deal with inflation once it's here. And for, they can't print oil, they can't print LNG export infrastructure, they can't, print fertilizer. And so they have to contend with the supply side as it is. And then their approach is to try to adjust the demand side, for better or worse, around the realities of that supply side. And so with unemployment officially pretty low and inflation officially pretty high, they have a pretty clear mandate according to the way, the legal structure that they're designed to operate under, to try to tighten monetary policy, which has the effect of reducing some marginal demand. And so if mortgage rates go up, and if it's harder to get a loan, and it's harder to issue different types of debt, you have kind of a slowing of money supply growth. You have a contraction in business conditions. And then, for example, right now we have an energy shortage. Maybe people take the less, they take the marginal vacation less, for example. These kind of more superfluous uses of energy, people will cut back on, which leaves more energy for some of the most mandatory and essential types of things out there. I think that's the approach they're going with. The big challenge, of course, is that it's hard to cause a little bit of a recession. Historically, every time employment goes up by 50 basis points, it keeps going from there, and it goes much higher than that. And so, because you have kind of a feedback loop where if you cause economic weakness, and then people get laid off, and that results in even less demand, and that means more businesses struggle, they lay off people, and it becomes a vicious cycle that keeps getting worse. And so I think that there's inherent challenge in the model of a bunch of people in the room trying to manage money supply for a whole country and trying to kind of thread the needle on the economy. So I think it's just an inherently nearly impossible job that they're trying to do. So to your other question about, are we entering recession? I think some indicators show that we're already in one. So a number of leading indicators show that we're basically in recession. Other ones, such as employment, that are more lagging, are showing that we're not in a recession yet. And I think that it partly has to do with the difference between nominal numbers and real numbers, because we have unusually high inflation, and therefore the types of recessions that people are looking at as their baseline for what a recession looks like, this one looks somewhat different than that. And so you can have a recession and even employment cuts in real terms, and not necessarily nominal terms. And what I mean by that, for example, is in the US, wages went up something like 6% over the past year, but inflation was 8.6% officially. Food at home went up 12%, high protein food went up 14%, gasoline went up 50%. And so, the average person feels like it's a recession. I mean, they feel like they got a pay cut. They feel like, that they are able to buy less than they could last year, and that's because that's correct. So in real terms, they're worse off than they were a year ago, even though employment rates are still pretty good. And so I think that this recession or this either that we're going into or maybe already in
Yeah.
is, this period of economic weakness, we can call it, is somewhat different than the recessions we've been used to in the past couple decades. But I think that either way you look at it is a period of economic weakness. And I think for a number of countries in Europe, it's worse, obviously, because they have a more problematic energy situation, right? I mean, it's hard to not have a recession
Mm,
in Germany, for example, when you're a manufacturing powerhouse and your energy prices have spiked, horribly.
mm.
And so I think that in real terms, a number of markets are either in a recession or entering this kind of big soft patch that we're in.
Do you think this recession is inflationary or going to be deflationary?
So generally, even in inflationary periods,
Mm,
usually economic contractions are disinflationary, but compared to the inflation that you're already in. So for example, in the 1970s, even
yeah.
though that was a very inflationary decade, you had more inflationary and less inflationary periods. And that was partly because there were periods where central banks would try to fight back. There were periods we had economic contractions, and those were generally the more disinflationary periods. But that could mean, for example, you go in the 70s, you'd go from say 8% inflation down to 4% inflation. It was still an inflationary environment, just less so, because you had that contraction in demand. And so that's how I would
Mm,
approach it here, where I think that we're more structurally inflationary until we get more energy online, until we kind of solve some of these supply side issues. And the inflation would be quick to reemerge whenever we have the next growth cycle. But I think that during these sharp pullbacks in demand, you can get a leveling out, or even in some of the more volatile cases, a downward move in a number of commodity prices and a number of inflationary indicators. We also see, for example, that money supply is going up a lot more slowly than it was over the past couple of years. And so I think that we're probably encountering a leveling out or cool down in inflation, but that there's still those inherently inflationary pressures.
thank you very much, Lyn. By the way, guys, please do check out Lyn's premium newsletter. I think it's definitely worth taking out the subscription. Please go to lynalden.com/premium, and you can find out all the details about her premium subscription. And definitely please do subscribe. I think it's really worth it. Can you just explain briefly what people can get in your premium subscription as well as your free newsletter?
Sure, happy to. So I kind of do three types of material on my website. So one is I put out a couple, these long-term pieces that focus on evergreen types of content. So I explore a subject and kind of write about it. The other thing I do is I have a public newsletter that comes out every 6 weeks on average, and that gets a little bit more tactical and time sensitive and focuses on what's happening with markets, what is the macro outlook at this current time. And then that's the majority of my content. But then I have a fairly low cost research service that comes out every 2 weeks, and that's even more tactical. And that's kind of diving into, okay, what's happening in markets, across treasuries, gold, credit markets, stock market, global markets, digital assets. What's happening, all these different ecosystems, what's of interest, and then I often dive into a specific company or a specific industry as like an opportunity. And so that's kind of my most frequent level of update, where I'm sharing what I'm investing in, and I'm kind of focusing on all these different things that are happening in the world.
Len, thanks very much. And you've been a wonderful guest, and you've been one of the most interesting people I've talked to, certainly in these interviews. Really appreciate it.
Thanks for having me. Happy to be here.